Thank you, everyone, for coming to this episode of Financial Tides. My name is Taylor Parrillo, certified financial planner, and I am joined by my co host.
John Parrillo, certified financial planner and chartered financial consultant.
Awesome. And we are going to be talking today about interest rates, its impact on mortgage payments, and how we can get people into houses these days with the way things are. As interest rates rise, we know it can affect a lot of aspects of your life. The biggest one is your mortgage payment. John, what are some of those main factors that affect interest rates?
Well, before I go there, I'd like to say that, I think we've always thought of interest rates as the cost of money. That's what the money costs, the interest rate. And the factors, the macro and micro factors are economic strength, inflation, government policy like Fed policy, supply and demand, credit risk, and the loan period. And the loan period is a personal one that you decide on, right? So that affects your rate. And something else that affects your personal level rate more so than the published rates is your credit score. If you've got a credit score of 740, you're going to be in good shape. You're going to get a good deal. You're down in the high 500s, you might not even get a mortgage. Or if you've got a lot of credit card debt, that's going to be a problem. So work on that credit score to keep that strong for when you're ready to buy. And then speaking of buying, should I buy a house right now, Taylor? Rates are so high.
Yeah, and I think a lot of my clients are asking me that right now is it a good time to buy? And I think that while you will be paying extra in the way of interest, and I think that it really hurts in the immediate term. I think the fact that you keep your option to refinance and the bank doesn't have the option to come back to you and say, hey, interest rates went up. We want to raise your interest rate as long as you're not in an adjustable mortgage. Whereas in your case, you can refinance it if it goes down. I think that's a very powerful reason to buy now. And that's what I've been recommending to my clients.
Yeah, and if you're waiting with all the other millions of people that are waiting as well, right? So you're in that pool of waiters, and there's limited supply. Why do you think there's such limited inventory right now?
Yeah, and I think that just before we jump to the limited inventory, I think that those people are on the sidelines because of how high the rates are. They're not qualifying for these mortgages. And I think with that being said, that if interest rates do come down, those people flood the market and become part of that buying pool. And the demand now for houses is increasing while supply is staying low. So that kind of jumps over to your question to me is why is supply so low? And I just don't see people really wanting to sell a house when they're in a 3% 30-year fixed loan that they refinanced 2, 3 years ago. It doesn't make sense unless they have the money to go buy somewhere with cash that they end up choosing to have an 8% mortgage instead of a 3% mortgage.
Yep, well said. I've got it. I locked in at 2.125% a few years ago, and it means, I don't want to say I'm trapped here, but because I love my house, but that's my cost of money, 2.125%. People would die for that right now, and many people have that, and that's why they're staying. We talk to people every week that are staying put because of their low interest rate. So what are you actually telling the client that calls you up and says, "What should I do?"
Yeah, I've been saying this for a while, but get in a property while you can. Right now, if you're renting somewhere, you're paying somebody else's bills, which in my opinion doesn't make much sense. Um, Even if you have to get in a place below your means or below what you really want, it's not going to be oh, I'll find my dream home for the first house purchase. It's better to be in an appreciating asset that will grow and you can keep saving outside of that and hope to upgrade either by buying a new house at some point in time or remodeling your existing house and making it closer to what you want. But with the way that the market is and it's such a thin market with not a lot of supply out there, I would say be very cautious trying to find the perfect place and to just try to get into something that meets a lot of your needs.
Yeah, so give us an example, like with a $300,000 house, 1% increase, let's say 20% down. So they're financing $240,000. What does 1% do an interest rate increase to that loan?
Yeah, so interest rates going up about 1% or so on a smaller mortgage like that one is only going to increase it about $134 a month if you go from 3% to 4%. So it doesn't sound like a lot, but it does add up over time. Over the life of the loan, it's going to be a big interest cost. And then when you start looking at that, either amplifying it to the current situation we're in, where it's 8%, or if you look at it in like the situation out here in California, where the average home cost in San Diego, I think it's above 800,000 now, you're going to start seeing it get to be quite amplified in each scenario of what 1% looks like added on, or going all the way up to 8%. So I think that you have to be kind of ready for some of the ways to save money on homes, which I think if you look at the average monthly payment right now, I think it's at around 2,800 on a 30-year fix, John.
Yeah, 28, 23 for a 30-year fix is the national average right now. And you think about some people in California, as you mentioned, would love to be at 28, 23. They're at 5,000. And a lot of people on this call have no mortgages. So that should be a pretty surprising number if you hear it. So what are some of the ways that they can reduce that?
Yeah, so I think people getting in now and they're buying a house now, they're getting in on a 30-year fixed rate mortgage. I think the first thing they have to do is look for that opportunity to refinance. I think you start seeing rates come down at any point in time. That's something that you want to be ready to do, ready to pounce on. Don't wait for the perfect. Again, it's not that big of a difference. If you're gonna get to 6, you can refinance again if it does get down to 4. But I wouldn't wait for it to try to get down to 4 and hope for the best and accidentally wait until rates go back up again. So that's the first thing. And then the other thing that we tell clients to think about is think about making 26 payments. You get biweekly payments. Most people get biweekly payments. So every time you get a paycheck, you have half of your mortgage payment go out. Half of your mortgage payment over 12 months is only 24 payments. So by doing 26 along with your paychecks, you're going to end up making an extra month's worth of payments through the course of the year, which can go towards principal and reduce the amount of interest that you're actually paying over the life of the loan, especially towards the beginning of your loan, where your payment is heavily weighted towards the interest portion as opposed to the principal portion. So,
Yeah.
one other way to save money is private mortgage insurance. So, John, tell me or tell us a little bit about what private mortgage insurance is.
Yeah, the nickname is PMI, right? It's the bank's version of default risk protection for themselves. So you don't have 20% down. They say you've got to pay us an extra X amount per month because you're in a pool of borrowers that are more likely to default over time. So they put it on the mortgage and it stays on the mortgage forever unless you tell them, hey, I'm now above the loan to value ratio. And that's a moving number. We say 20%, it might be 22%. But I know you had experience getting yours removed due to the appreciation in your house.
Yeah, so when I purchased my first home in Arizona, when I was still living out there, the property had the private mortgage insurance on it, and it's something that it costs extra and it's not extremely necessary if you're a good steward of your money and you're paying on time. So it's not something for you like other insurance, it's for the actual mortgage company. So I didn't want to continue paying for the mortgage company to be protected, knowing I was going to continue paying my loans. So loan to value is really the big number that they look at. Normally, when you're paying on your loan, eventually you'll get to the threshold where your loan to value is under that and PMI will fall off the loan. But what happens, we all know, is house prices go up, they go down, and the value recently over the last 3 years have skyrocketed. So when the values started going up, I consistently was kind of gauging where my value of my home was at. And if it was reaching that, it's a 78% threshold for loan to value. So the value of your home has to be above 78% of what that loan, or the value of the loan has to be below 78% of what that value of your home is. So once you hit that threshold, you can call up your mortgage company. They'll send you someone out to appraise it. By appraising it, they're just confirming that value number with a licensed appraiser, not just some Zillow number. And if it does meet that threshold, they'll knock that off your payment. So we review it a lot with clients because we don't want to send somebody too early to try to do that and have to send out multiple appraisals, which cost money in and of themselves. And you end up wasting more money, being a little too eager to get rid of it. But I think once you start getting close to that 75% loan to value is when we typically would recommend a client to give it a shot and see if they can get their PMI knocked off. But
Good.
that's the last thing I have for today. John, you want to tie us up?
Yeah, I just want one more thought. I know a lot of people are paperless now, but even with paperless, you can do this. But I always recommend that you look and compare your mortgage statements month over month, 10 of them in a row. It's really fun to watch that principal interest variable change. You say, hey, look, my $2,000 payment was $1,500 interest 12 months ago. Then it was 1480. Then it was 1440. And you can watch the change in the relationship between interest and principal on there. And there's so much other valuable information on that mortgage statement that'll help you stay in touch with your mortgage and be more focused on fixing it instead of setting it on autopilot and not thinking about it. So, those are my final thoughts on that. And thank you for joining Financial Tides again. Feel free to share this with, friends, neighbors, family, anybody that you think needs help or guidance. Hopefully they'll enjoy it too. And if anybody has any questions, don't hesitate to reach out. Thanks and have a great day.
Thanks, everyone.
John Parrillo and Taylor Parrillo are financial advisors offering securities through Cetera Advisors LLC, a registered broker-dealer, doing insurance business in California as CFGA Insurance Agency LLC, member FINRA/SIPC. Advisory services offered through Cetera Investment Advisors LLC, a registered investment advisor. Cetera firms are under separate ownerships from any other named entity. California insurance licenses number 0F60123 and 0M90666, 6265 Greenwich Drive, Suite 251, San Diego, California 92122. The views depicted in this material are for information purposes only and are not necessarily those of Cetera Advisors LLC. They should not be considered specific advice or recommendations for any individual. Neither Cetera Advisors LLC nor any of its representatives may give legal or tax advice.